What's up everyone, it's Scotty with MoneyVest. So in this video, we are going to be talking about Magnificent 7 stocks. And of course, this is going to be a very important video because MAG7 has really what's carried the markets in 2023. I mean, that's literally a fact because majority of the gains have come from the core top 7 big tech companies. These are your Apples and Microsofts and Googles, Meta, Nvidia, Tesla, included as well. Amazon, of course, part of that list. So in this video, we wanted to break down a couple different reports and also talk in an overview basis where we are in terms of year-to-date gains and, of course, the valuations for these companies going into 2024. So hope you all enjoy this video. Find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. I would really appreciate that. And links to our Discord and Patreon is going to be down below. There is a 16% annual discount that does expire at the end of December, so 2 more days left if you want to take advantage of that. And of course, you get access to all the members-only videos and of course Discord channels including buy and sell alerts, options alerts, and trade ideas. And of course, all the individual courses right now are 50% off, coupon code 2024. And of course, the bundles are going to be up to 70% off. This is the biggest sale of the year. The full 4-course bundle is going to be 70% off. Again, coupon code is going to be 2024. Link's going to be down below so you can access and join while this sale is still happening. So here's why the Magnificent 7 tech stocks will continue to outperform the S&P 493 in 2024 according to Goldman Sachs. So as we already know, on a year-to-date basis, if you take a look at these 7 stocks, the gains have been incredible and the market concentration has increased to almost 30%, right? So 35%, that's really where we are with the concentration between these 7 companies. Apple is up 47%, Amazon is up 77%, Tesla's up over 109%, Nvidia has gone up 233%, so it's basically 3x. Microsoft 54%, Google 56%, and Meta is up 188%. So when these stocks are up like this much, of course the markets are going to rip absolutely incredibly, with S&P up over 24% on the year. And of course, the NASDAQ, which is, if you take a look at NDX, NASDAQ 100, more specifically, at an all-time high. And of course, I think on a year-to-date basis, up over 44% or something, 52% on a year-to-date basis, which is the NASDAQ 100. And the regular NASDAQ composite is up. It doesn't say, but I think it's up a little bit over 40% as well. So 42% is the year-to-date gain. So regardless, I mean, these are the 7 companies that have basically carried the markets. There's no doubt about it. This is a fact. But we have to understand the valuations because these companies are leading charge in cloud technology, of course, hardware, software, artificial intelligence, advertising, e-commerce, cloud applications, and of course, software, everything we spend a lot of our times using the products and services of these companies right here, which is why they're so successful, which is why these are companies that are going to be around for a very long time. They're going to continue to essentially innovate and do a lot of adaptation for mergers and acquisitions. They're going to acquire a lot of technology, create a lot of new technology, and as a result, they're going to continue to perform well. But our question really needs to be, what is the appropriate valuation? What's the right price for these companies? We already know these are great businesses, but what we have to really understand is what's the right price, what's the right appropriate intrinsic value for these businesses where they are indeed worth buying, because your future returns are always going to be determined by the price paid, okay? That's also a fact in investing in general. Whatever you potentially forecast to make in terms of returns is going to be dictated by how much you pay in price. If you pay a higher price, your future returns are going to be lower. If you pay a lower price, your future returns are going to be higher. It's that simple. So Goldman Sachs says the fundamentals are better. The 7 mega cap stocks have now more attractive fundamentals when compared to the S&P's 500 bottom 493 companies. They sport faster growth, higher profit margins, cleaner balance sheets, and reasonable valuations on a relative basis. Analyst estimates show that mega cap tech stocks grow sales at a CAGR of 11% through 2025 compared with just 3% of the rest of the S&P 500, and the net margins of the Magnificent 7 are twice the margins of the rest of the index. Consensus expects this gap will persist through 2025 as well. So not only are we looking at very strong balance sheets, we're also looking at very good margins and potential growth for sales all the way through 2025. And mega cap tech stocks crashed in 2022. So the sharp outperformance in mega cap tech stocks This year comes after the brutal 2022 in which a number of stocks were severely punished by investors from their peak. Meta fell more than 70%, Nvidia dropped more than 60%, Amazon's share price was down 50% as well, and Tesla at one point was also down, I think, over 50% from its all-time highs. And the dominance of mega cap tech in 2023 largely reflected a reversal of meaningful underperformance in 2022. And of course, we have seen nothing but an incredible rally, and there's no return relationship for top 7 S&P 500 companies. So what they're saying is that the 30 percentage point outperformance on these 7 stocks, so the fact that these 7 have outperformed the rest of the S&P by over 30%, has no correlation with what the future returns look like. However, this is the second largest difference since 1970s. So what this means is that this is the second largest annual difference in outperformance since 1970s. While the magnitude of the outperformance has been striking, there has been no reliable historical relationship between the trailing versus the forward 12-month outperformance of the largest 7 S&P 500 constituents versus the remainder of the index as well. And Oppenheimer has a year-end target with a 7% gain on the S&P, all on the power of Magnificent 7, and they're expecting us to get up to at least 4,900 by the year. This is Oppenheimer's year-end target, leaves upside S&P 500. Of course, this is from December 25th, so this is a little bit an older article, but we pretty much ended up on the year at just under 4,800. So we ended up at 4,769 to close out the entire year. So when it comes to the actual valuations, right? So this is really what's the most important thing. We already know sales are growing. We know margins are great. We know the balance sheets are fantastic. This is really the main driving force behind whether Apple's a buy or not, whether Amazon's a buy or not, whether Tesla's a buy or not, because market already understands and knows. You ask anyone, all investors agree on the idea that these are fantastic businesses, great companies, innovating companies, leading in technology, and of course, everything that the world is going to see and use and do are going to come and be created by these companies, right? That's a fact. But the real question, like I said, becomes what is the appropriate valuation? Because if you do the math, and let's just take the median of the entire PE multiples for these companies, we arrive at a number of 33.49, right? So this is the median right here. The average, if you take a look, so let's just do the average here for these companies, and that is going to be at 41.27, right? So really, really high. And if you run these analysis across the board, you'll notice the price to sales median at 7.5, average is over 9, which I guess is quite reasonable. So price to sales is definitely quite reasonable, but I'm going to highlight a couple of companies here. So Nvidia, for example, 20 times sales is certainly concerning in my opinion, compared to, of course, Amazon's pulling down on the overall average of 2.78. So really, really low. And then, of course, if you take a look at Tesla is at 8.28, Apple's at 7.5. Also quite reasonable. Microsoft, software company, high margins, very reasonable. Google and Meta, I would still argue, are somewhat low compared to where they should be. At 5.7 is for Google and just under 7 for Meta. So maybe there is more potential in those two companies. And when it comes to price to free cash flow, again, Google and Meta, quite reasonable, really, really low. With Amazon at over 22, also quite reasonable. Microsoft's at 26, also really low, and Apple 24, also quite stable. Tesla and Nvidia are once again a little bit more on the higher end of the spectrum at 43, 63, respectively for Nvidia and Tesla. Enterprise value to EBITDA, again, same story. A lot of these are really low, especially when you look at Google and Meta. We're looking at 12 to 13 times enterprise value to EBITDA for these companies, and Tesla and Nvidia, once again, a little bit more on the higher side of 36 and 47 at the moment. And finally, we arrive at price to earnings. I would argue that Google, Meta, even maybe even Apple to some extent is quite reasonable, but Apple's growth, I believe, is going to be lower. They've done a lot of financial engineering with a lot of share buybacks, which is one of the reasons why their actual earnings growth is a little bit higher than what the actual net income growth is. But Google and Meta 24, 25, they've obviously done really well, kind of pushing up from 12, 13 levels from 2022. October 22, they were like really, really low. And they've done an incredible job kind of pushing back up. But Tesla is pretty expensive, Amazon's pretty expensive, and of course, Nvidia is also pretty expensive from a price to earnings basis. Microsoft, I would also argue, is expensive relative to its growth, meaning that 33 times earnings is definitely high compared to the actual growth rate expected for earnings for Microsoft, and the same is true for Apple as well. So I'm definitely going to put a yellow over here. So, when it comes to like these Magnificent Seven, of course, the momentum's in their favor. There's a lot of potential, but they've also seen a lot of liquidity flood into these stocks, which is exactly one of the reasons why I believe that the tech trade is very overcrowded right now. Okay. It is overcrowded in the sense that not only are these year-to-date gains absolutely enormous by going up over 40, 50, 70%, hundreds of percents, but also the concentration is really, really narrow. Like it's really narrow. Like we haven't seen a broad-based participation. Other sectors have still trailed behind these MAG7. And as a result, they've become overbought and they've also become somewhat expensive on a case-by-case basis, right? Like for example, I would argue Google, Meta, still quite reasonable in terms of their valuations. Apple, somewhat reasonable, maybe not on a price earnings basis, but most certainly on a price to sales, maybe even on a price to free cash flow basis, because free cash flow growth is going to be a little bit higher than net income growth for Apple. And then of course, Tesla's pretty expensive, so not really touching here. I'm only selling calls. Nvidia, of course, not really buying at these prices at over $500 a share. Amazon is a little bit of an interesting one because they've got their acquisition with Rivian and their ownership in Rivian, and as a result, the price to earnings is not the best metric for them. So other than that, price to earnings and price to free cash flow and enterprise value EBITDA quite suggest that reasonable valuations here. In fact, Amazon on a growth adjusted basis is my highest conviction stock right now because I believe that as the company kind of shifts that focus more towards earnings and profitability, Amazon could indeed provide us with some very strong growth rate over the next 10 years, even more than Tesla or Nvidia. I've got a bet with myself that Amazon is actually going to offer up a pretty solid, pretty aggressive growth rate for earnings when compared to Tesla and Nvidia, because most of the revenue has already been generated. All they have to do is now become more and more efficient by generating more profits and net income on the bottom line, and as a result, grow their earnings per share. So that's one of the reasons why I'm incredibly bullish on Amazon long term, despite the higher PE multiple because of the Rivian acquisitions kind of playing a role here. But I do like Amazon best on a growth adjusted basis. Then I would argue Google and Meta are somewhat reasonable at these levels. Tesla, Nvidia, they need to come down in order for me to be like super excited to be buying for them. And Microsoft and Apple are also a little bit of a wilder card because yes, they're safe stocks. Yes, they're stocks where investors can hide out in. And they can certainly they've got the best balance sheet and they're going to continue to grow. They're going to do well, but it's just the growth rates are not suggestive of where the price to earnings multiples are trading at the moment. So this does seem a little bit more on the overcrowded side and people kind of hiding out in Apple and Microsoft because they've done really well, of course. No doubt they're up 40, 50%. But can this continue over the next year? That's what we're here to discuss. And in my opinion, I think Amazon, Google, Meta are going to somewhat perform better in 2024 compared to some of these companies that have already rallied more and their valuations have exploded significantly. But of course, overall, these 7 companies are going to continue, in my opinion, to do really well over the long term. And this is where most of my portfolio is going to be concentrated in, of course, with other sectors and other stocks also included. So hope you all enjoyed this video and found it helpful. Make sure that you drop a like. Don't forget to subscribe. And also do check out the full 4-course bundle, 70% off. Coupon code is going to be 2024. And of course, do check out the Patreon and the links down below with that 16% annual discount that does expire at the end of this month. Limited time and limited spots left. As always, happy investing. I'll see you all in the next video.